All right, so thank you everyone for coming to our meeting of the Champaign Blockchain Meetup Group. Today we're going to be joined by Andrew Gordon from the Gordon Law Group. He's the managing attorney for the Gordon Law Group, who graduated from Chicago Kent College of Law and is also a certified public accountant with a master's degree from right here at the University of Illinois. During law school, he got experience with tax issues by volunteering for the Low Income Taxpayer Clinic. And he also did a lot of entrepreneurship in his undergrad days, helping to form the club that is now Illinois Enactus, which helps encourage students to think about ways that they can use free enterprise to improve people's lives and work towards empowering people. As a practice, the Gordon Law, Andrew at his firm concentrates on tax controversy and compliance, cryptocurrency law, FTC defense, internet law, and corporate litigation. He's also popular among tech startups and affiliate marketers looking to stay on the right side of the legal fence while enhancing their bottom lines and minimizing liability. So he's here today to talk to us about cryptocurrency law, all the things that we might need to worry about with tax season here upon us, and perhaps some of the things we can look forward to in the future in terms of cryptocurrency and the legal sphere. So Andrew, I will turn it over to you, and thank you so much for being with us here today.
Yeah, and Adam, thank you very much for that very detailed introduction. Some things I even forgot about, so I appreciate it. So yeah, as Adam mentioned, I'm going to be talking about crypto tax today. I think one of the unfortunate parts about Zoom is the limited interaction with the audience. And so if you have any questions as I go, please interrupt me, unmute yourself, raise a hand, do whatever, be rude, interrupt. I think it'll make it all more interesting. I can talk about all different topics in the tax area, but I'd much rather talk about what you're all interested in. So as we go, like I said, please feel free to stop with questions, thoughts, concerns, and chat through it. So I'm going to share my screen now. All right, Crypto Tax 101, everyone's favorite topic. So today we're going to be talking about a few different things. Who needs to report crypto and why? How to fix past mistakes if you didn't report crypto properly in the past. How crypto taxes work, just in general. How are you taxed? How do you have to report? Oh, and step by step, how do you report? And then to close, some tax saving tips. So crypto in general kind of has a bad reputation when it comes to tax. A lot of people think that crypto is taxed unfairly, but in actuality, there's a lot of ways that you could use the tax code to your advantage and minimize tax through just some planning. So we'll talk about some of those tips at the end as well. So let's dive in. First, about me. I'm an attorney and CPA, did my undergrad at the University of Illinois. As Adam mentioned, also master's in accounting at U of I. And then from there, went to law school at Chicago Kent. I've been working in crypto tax specifically since late 2013, 2014. So I've personally been in crypto since before then, but we actually started to have clients in the space around that time period. And it actually wasn't until 2014 that the IRS even started to define what crypto was. So we've been very active since the early days. So if anyone has any questions about that as well, please feel free to ask. We help people with a wide variety of crypto tax issues. We help with crypto tax returns, including reconciling transactions to create tax reports, which we'll talk about today. We also have a lot of experience in audits, both in the crypto space and outside of crypto. For years, we've been defending clients in IRS and Illinois state audits. And recently, we've been seeing more and more that are focused on crypto. And so we have experience in that too. So if anyone has any questions about the audit side of things, happy to talk about that. And tax debts. Now with crypto where it is, hopefully everyone is actually up. It's nearly impossible to be down if you're holding Bitcoin and some other tokens, but if you had a tax debt and you couldn't pay it because perhaps the value of crypto went down, we help with things like that too. And to conclude, tax planning. tax strategies. There's ways to minimize your taxes if you are trading crypto. So it's something that you shouldn't just ignore till after the year ends. There are things you have to do throughout the year and before the year ends, and we'll talk about those later on. So that's about me. So who needs to report crypto and why? Well, one of the first reasons and most important reasons is, well, overall, it's your legal obligation. So as a US person, US citizen, you are required to report crypto. But now more than ever, it is front and center on the IRS's radar and agenda. So much so that the IRS Department of Treasury gave some of the most expensive real estate in the world to a question related to crypto. And so there's now a question on the 2020 tax return right after your name and address that says at any time during 2020, did you receive, sell, send, exchange, or otherwise acquire financial interest in any virtual currency? Yes or no? And to be repetitive, this is right after your name and address. This is something that everyone has to fill out. Even if you don't have other schedules, it is right there. So there's not a maybe, there's not an I'm not sure, it's yes or no. And so the IRS is alerting tax filers that, hey, we're asking about crypto. There are requirements related to crypto, and we're going to make you answer yes or no as to whether or not you had any of these activities during the year. So although there's always been an obligation to file, and you should certainly fix prior years, and we'll talk about that, 2020 makes it impossible to avoid without potentially even answering fraudulently or willfully incorrectly. Because if you had crypto and you check the box no, you've now put yourself out there and answered something incorrectly. So it's something that's now very crucial to answer correctly. So as I mentioned, it has always been the law to report crypto. It's not something that occurred in 2018 when like-kind exchange was removed. It's something that's always been the case. So, and it's not just when the IRS creates new guidance. It's always been the case that crypto is reportable. And if you don't report, and I'm not trying to scare everyone, but if you don't, there can be penalties. First, on the civil side, monetary penalties. A 20% accuracy penalty or an understatement penalty is fairly typical if the IRS audits you and finds that you have an understatement of income. So that's just one type of penalty. If they think that there's fraud, and just this is on the civil side, not even criminal, but if for instance, in the future, we're anticipating that if people check no and then don't report crypto, that's a sign of potential willfulness or fraud. So there can be an even greater penalty, up to 75%, if the IRS thinks there's fraud. Criminal penalties, $250,000 or 5 years in prison per violation. So this is generally per year. Right now, one of the first criminal tax cases is ongoing for John McAfee, which you all may have heard about. He's actually being charged with tax crimes. That's really the core of the accusations against him. And so, you know, when exploring all the different ways potentially that the government could have gone after him, it's tax, at least right now, that they're charging him with potential violations for. Now, as a attorney and as a CPA, one of the questions that I hate being asked, but I'm going to answer it right now, is how will the IRS ever find out? And the reason that I hate being asked this question is because, as I mentioned in the last slide, it's your legal obligation. It's not a question of, well, will they ever find me? You need to do it. But for those of you that need to know the answer to this question, it's very easy for the IRS to find out about crypto activity. In fact, almost all US exchanges, and now even some foreign exchanges, are reporting information to the IRS. And a few years back, actually time flies, it's been several years now, Coinbase received a very broad information request. They fought it for years, but ultimately Coinbase turned over a lot of information and continues to do so about account holders. Also, the IRS can request specific information. If they want information from an exchange, it's fairly easy for them to get it. Also, just as part of standard IRS audits, the IRS is now identifying crypto activity. For instance, as part of a typical audit, they will ask for bank statements. And if the examiner is going through a bank statement and sees that there's a withdrawal to Coinbase or a deposit from Coinbase or another exchange, it's very clear that there's crypto activity. And then it's easy to cross-reference the return and see if it was reported. Also, income to your bank accounts. So certain banks or banks in general, if there's deposits over certain amounts in cash, will report to the Department of Treasury. And as I mentioned before, just as part of a normal audit, just tracing income, it's very easy to see. Usually the inflows or outflows of fiat, of US currency, to crypto exchanges. Unless you're using just a over-the-counter and paying someone over the counter or using local Bitcoins and meeting someone in a parking lot, as long as you're using an exchange, it's going to touch a bank account. The IRS has been on a warpath. They have been doing several things over the years, and more in the last few months. The IRS was initially, some people thought, slow to issue guidance on crypto. It wasn't until 2014 that the IRS even defined crypto as property. Up until then, there was some question as to whether it would be considered currency or property. Property being more akin to stocks, whereas currency being like the US dollar. You don't report gains or losses when you spend US dollars or receive it. Of course, for income you do, but not in different fluctuations in the US dollar value. Property, on the other hand, when there's changes in price, you do report that on your tax return, and you do pay taxes. So 2014 was when that was first defined. Then 2019, the IRS issued more guidance on airdrops and forks. There was uncertainty previously as to whether airdrops and forks were taxed when initially received. They issued guidance on that. And then they also issued a pretty detailed FAQ answering a lot of questions about crypto tax. So the IRS has been answering a lot of questions, but in the IRS's eyes, these aren't new answers. These were things that always existed. It's just clarification of the rules in a FAQ form, since some people didn't know these things necessarily. Increased audits. In the last year, we've seen more audits than in the last 5 years specific to crypto. In fact, the IRS has a dedicated unit to do crypto audits. They do have field agents that conduct the audits around the US, but they have a central unit that handles much of the crypto analysis. So that they are people that actually know what they're doing, know about crypto, that are running the crypto parts. And we're seeing a lot of these. They've sent out thousands of warning letters. They've sent thousands of bills to people, CP 2000 notices saying that you just owed the IRS a certain amount, or that they proposed a certain amount was due because you didn't report crypto, and perhaps they had information from Coinbase or other exchanges. And these letters and these invoices were typically very bad. They weren't doing the calculations to benefit you. Also, the John McAfee case that I mentioned before, and the 2020 crypto question. And so this is one of the notices that was sent out on the right, sample IRS letter. And so they sent out thousands of these to people, and it basically informed them that they needed to report crypto. So if there was a future argument by people that, hey, I didn't know I needed to report, this is the IRS sending you a letter telling you why they're writing you, what you need to do, and also other rules about crypto tax reporting to put you on notice of those requirements. And yeah, again, the 2020 tax question. So if you're hearing all of this and you're saying, you know, oh shoot, sounds like I've got quite the pickle. I've got some crypto trades in 2016, 17, 18, or other years, 2019, that weren't reported. And I should say in 2019, there was a crypto tax question on the tax return. It was just on Schedule 1. So not everyone necessarily had to answer it. But now it's right after your name and address, so everyone has to answer it. But if you had crypto in prior years and you didn't report, Fear not. Well, I should say definitely be concerned, but there are solutions. There are ways to get in front of the situation before potentially it's a bigger problem. So if you didn't report, one of the first things that I'd suggest is that we actually do the work and figure out what needs to be reported. So reconcile the transactions, calculate the gains or losses per year, and then file amendments for each of the years. You can go back several years. You can only get refunds for 3 years, but you can go back even further if you want to amend your tax returns to properly report. And we'd suggest doing so in most situations. Another question that often comes out is what do I do if I'm locked out of my exchanges? Or what do I do if I have a lost wallet or information or data that I just can't get? Is that an excuse to not file? The answer is no. The IRS expects you to do the best you can, and the IRS does not expect perfection. There are exchanges that have been closed, Mt. Gox, other exchanges that have been hacked. Things have happened over the years. If you can't get the data, you can't get it. But in most cases, we can help reconstruct a lot of the records with basic blockchain analysis. You can identify a lot of the inputs and outputs. So even if you don't have all the data, we can often fill gaps, create assumptions as necessary. Even though it may be a complex and in some cases even costly process, it's much better to fix these problems before the IRS contacts you. Because if you are audited, as we talked about, there are all these different penalties that you could face. And even if the IRS just sends you a bill, I have yet to see a IRS CP 2000 notice for crypto be correct. And so you're going to face more time, more money in trying to address this than if you fix it now. But also I should mention, given the price of crypto today, assuming that it continues to also increase and assuming that you're going to sell, exchange, or cash out at some point, you need to have all the prior records, because in doing so, you'll have cost basis and also a holding period that can change over the years as you're exchanging from crypto to crypto, buying and selling. And so when you eventually sell, you're going to need to report. And so you'll need all of the cost basis and holding period data from those prior years. And if you don't have it, it could be even more negative, because then potentially you have just a short-term gain when you should have had a long-term, but you just can't support it. Or perhaps you had cost basis, but you don't have any of the records to support it, so you have to show 0. So several reasons why it makes sense to fix the past crypto mistakes. So let's talk about how crypto taxes work. As I mentioned before, crypto is property, so it's not currency for tax purposes, which means that every time you sell, exchange, spend, mine, receive crypto as payment for services, staking rewards, interest payments, basically anything other than a transfer between your own accounts is a potentially taxable transaction and needs to be reported. And it's true even if you have a loss. It's true even if you break even. It's true even if it's a stable coin. You have to report each of the events on your tax return, calculate a gain or loss. Even though all of those transactions are reported, you only pay taxes on capital gains and income, and your gains can be reduced by losses and so forth, but all of the transactions are generally reported on your tax return. Depending on if the capital gains are short-term or long-term, there's different tax rates. Short-term capital gains are property that you hold for less than a year. Long-term is greater than a year. So a great tax strategy is hold crypto for longer than a year. In many cases, you'll cut your tax rate in about half by holding for longer than a year rather than selling for less than a year. So again, all of these transactions are reportable, but specifically you'd report it on Form 8949, which is also the same place that you report stocks or other property that you sell. So even if you or your accountant are not familiar with crypto trading necessarily, it's reported in much of the same way that stocks and other property are reported. One of the most common mistakes is thinking that crypto to crypto is not taxable or reportable. It is. And most people would argue it's always been the case. For 2018 forward, it's been clarified by Congress that it's only real estate that could qualify as what's referred to as a like-kind exchange. But before then, arguably, crypto wouldn't even be considered like-kind enough, one crypto or another, to qualify. So we would, and most practitioners agree, all crypto to crypto trades, all years, are taxable events need to be reported. Also, purchasing goods or services. If you use
Good
crypto,
question.
sure, go
Sorry to
for it.
interrupt.
No, please do. I needed a break. I needed to drink some water, so go for it.
Okay, is so. I mean, think about how to say this. So, selling crypto for U.S. dollars or spending crypto to purchase something, as far as taxes are concerned, is that taxed the same way?
Yes.
Okay.
So if you buy, say that you use Bitcoin to buy a cup of coffee at Starbucks, it would be considered as if you sold the Bitcoin for cash and then use that cash to buy the cup of coffee.
Okay.
Similarly, if you went crypto to crypto, it would be as if you sold the first one for cash, use that cash to buy the second.
Yeah. So buy crypto, wait a year before making any purchases to cut that in half, more or less.
Correct. Correct.
Okay.
If we're doing any sort of taxable transaction, wait a year or at least a year.
Makes sense.
Yeah.
Does that mean that we have a taxation for the change plus any due regular taxes on purchases or any other economic activity? Is that what I understood correctly?
Yeah. So for instance, you buy a cup of coffee with Bitcoin. Let's say you bought that Bitcoin when it was worth $10,000 and today it's 55, let's 50,000 or so. Then that cup of coffee is $5. Rough math, you would pay a gain on $4 on that Bitcoin because it would be treated as if you sold that Bitcoin for $5. And I believe in my hypo, you bought it for a dollar. And so that's a $4 spread. You'd report that event, pay tax on that $4. You may also pay sales tax at the point of sale, and that would be tacked on too.
Got it. If there's no change or gain, supposedly at some point it should like stabilize and then only variance up and down like any other currency or whatever, then that will be evaluated on that basis, right? It's not always, I guess what I'm trying to say, it's not always a gain or a loss. It might be just flat or break even. In that case, you should not see any of that, right?
Correct, and it's possible, but it would still be reportable on the
Right.
8949. But it would show, because on the form, and I'll show it later. You show the amount that you sold it for and the amount that you bought it for. And so if it hasn't changed, which is hypothetically possible with Bitcoin, probably more theoretical than likely. But for other coins, stable coins, for instance, you had a wallet of USDC, which is typically $1. Then you may just need to report the disposition, the sale, but there won't be a gain or loss.
Or so like if I want to buy a new altcoin, and so I go and I buy some Litecoin from an exchange and immediately exchange the Litecoin for that altcoin, then the Litecoin hasn't changed in that 5 seconds. Hopefully the Litecoin hasn't changed that much. That is basically a break even though it's been 2 steps. So it's gone through that transaction, right?
Yes and no. Theoretically, yes. Likely, no. Because even in 5 seconds, it's changed. And also because of fees and so forth, there's something that's changed there. You're probably getting more or less of that altcoin than if you would have directly bought it with cash. Even though theoretically, if say it didn't change at all, it would still be reportable. For instance, if you bought Litecoin with cash and then bought an ICO with that Litecoin, the purchase of the Litecoin would not be reportable, but the sale of the Litecoin for that ICO would. And let's say hypothetically the price didn't change, you would still show the cost basis and then the sales price being the same numbers, gain loss is 0. So it's possible, but still reportable.
Sure. Yeah. I get that I'd have to report it, but hopefully I'd only have to pay tax on like maybe 50 cents.
Yeah.
Um, I don't want to drag you too much into this rabbit hole, but we're talking hypothetically here, 10, 20 transactions. Pretend that our lifestyle changes and we're moving most uh, of this crypto coins and Litecoins and alike day by day. The level of transactions that we're going to be moving is like, how are we going to manage? Because this is going to be a micro ledger per person with, having to balance all that at the end and report it. How is the IRS expecting a simple person to track every single transaction, balance all that, and report it?
Yeah, no, it's a great question, and honestly, it's one of the main issues that I think are holding back general adoption and use case of daily use of crypto. And I actually created a series of videos talking about Facebook's proposal for Libra and how it would be a tax disaster. And I don't know if Mark was listening. I think maybe he was. But afterwards, they changed their approach from going from a basket of currencies to just being pegged 1-to-1 to the US dollar. Because if you have any crypto that's changing in value during the day, no one's gonna be buying a cup of coffee thinking, I've got to pay tax on $4 on this $5 cup of coffee. No one's going to want to do that. Number one, from a tax perspective. Number two, from a reporting standpoint, no one wants to keep track of that nonsense. And why would you do that? So I think in terms of adoption, hopefully Congress, the powers that be, will make changes like that. Other countries, Germany, for instance, has a de minimis law. I believe it's transactions less than either $100 or $500. Can't remember for certain, but there's a certain amount where if the transaction is less than that, no gain or loss, nothing to report. A change in policy to something like that would allow adoption much easier. Until then, though, every transaction must be reported. It's doable. It's pain, takes time. We do it for clients all the time. Businesses are going to face that same issue. And so we're seeing now Tesla and businesses starting to take crypto and interact in crypto. They're going to need to be reporting and keeping track of all of that. We've actually, as a firm, been working with businesses to do those things. But as an individual, for instance, one way to do it would be if you had a separate wallet specifically for your daily crypto use. And so you're not just generally going to your overall pool, but just you're using maybe a specific wallet that has only stable coins or something like that. All the transactions still reportable, but hopefully you don't have the tax events.
Andrew, can you hear me?
I can hear you.
Okay, sorry I'm late. I missed a lot of your stuff, but I wonder, do these rules, are they the same if I use euros?
Are you a U.S. Person or citizen?
Yes.
Or hypothetically?
But I'm just saying, what if I had euros and I bought and sold euros, exchanged them between pesos or dollars or whatever? Are these the same laws?
Nope.
Do I still have to pay? You mean I don't have to pay a capital gain going from euro and then back to dollar again?
Unless you're doing like currency trading or something like that. The IRS defined crypto back in 2014 as property rather than currency.
Right, a security, wasn't it?
Well, it just as property generally. Some crypto securities, some's not. But in doing so, they made it so that every time you convert from one to another, it's taxable. So they made that determination years ago, actually.
Seems like there's lots of arguments why it's not that. And it seems like they did it just for this purpose, to make it really hard to use.
To make it hard to use, I would agree that's the effect. Since the IRS in 2014 defined it as property, basically every other country followed suit. I'm not aware of any other countries that basically say crypto is well, I should say there are some crypto tax haven type places that say, hey, we're not going to tax crypto, but as long as you're a citizen of most industrialized countries, they tax crypto as property. And so that was just, yeah, a decision made early on. I do think in general, it makes sense because most people aren't using crypto for day-to-day use. Most people are trading or speculating with it more like it's a stock. And so the definition of property fits that. Most people don't buy US dollars or aren't holding US dollars to speculate or sell for future appreciation. So it's, to me, seems to fit property more, at least based on its current use.
Well, it's kind of circular though. I mean, that's why it's used this way. If it were easier, I would be using it.
Sure. Yeah. So I would encourage you to voice that to your Congress person and tell them to pass a de minimis law, because that achieves all the above. If you're using it on a daily basis under a certain dollar amount, not reportable. But if you're speculating on thousands of dollars, you should pay your tax.
Mm-hmm.
So maybe this would be later in the presentation, you would talk about this, but since we're kind of on that topic right now,
Yeah.
I've heard of bills before that talked about having a de minimis law like that. Is there anything that's currently being considered and that you think would have a shot of happening in the next 2 to 4 years?
Not specifically that I'm aware of, unfortunately. Generally speaking, the new chairperson of the SEC is very crypto friendly. And so maybe some of these things will start to happen, but unfortunately, I'm not aware of any specific bills to try to do so.
Okay.
Andrew, do you think crypto is perceived by the US government as a threat to its dollar system?
Well, it's hard for them not to, or I think
Right.
they should. They should, right? But I think what we've seen though is them recognizing it's here to stay. It's not going anywhere. It can't stop it. So we're best off regulating it and getting all the data and taxing it. That's how we'll make our money and stay in control by and in December. I don't know if any of you had seen, but right around Christmas, FinCEN, which is part of the Department of Treasury, released 2 proposals. And one was so that if you transfer from an exchange to a self-custody wallet, you'd have to provide KYC. That just turns the entire idea of crypto on its head. Whenever you have to transfer between wallets, you have to do KYC. Wow. So it's this movement, I think, by the government generally that, hey, this is here, it can be used in a lot of ways, and we need to make sure we can monitor it and to some extent control and tax it as it's being used more and more. So that was the first proposal. The second was that if you're using a foreign crypto exchange, that you have to report it on your FBAR, which is a foreign bank account report. So now so the IRS can get information on US exchanges very easily, as I talked about earlier in the presentation. But now the proposal is that foreign crypto accounts would be much like foreign bank accounts, where every year you have to report them, and if you don't, there can be severe penalties.
Well, they were also saying that the transfer reporting had to be like $2,000 or something that low also, right? Even if you're just transferring around. So that's, right. Yeah, it's pretty, I mean, I understand regulation. That's some pretty heavy regulation right there.
Yeah. Right.
Is like when I first began or had a wallet a couple of years ago, maybe 2, I practiced moving it around between friends just to see how it worked and see how long. Are those transactions taxable? I mean, they don't know. Seems like they would see some activity and, if they wanted to, they could detect such things. And like I sent some to my son, to his wallet, and then he sent it back. So we were just kind of experimenting.
Yeah.
But is that, they're going to think of that as taxable?
It's not taxable, but it's something that you should definitely keep records for. So if you're reconciling your activity every year, you're going to see these withdrawals and deposits. You're going to need to know, well, are these taxable withdrawals or deposits or not? And what you're describing sounds like loans. short-term, paid back, no interest type loans, but they're not taxable events. You're loaning him money, he's paying it back, he's loaning you. That, I mean, from like a tax standpoint, that's kind of what's happening, or from an accounting standpoint, that's what's happening, but it's not actually taxable. So, but I would make sure you have the record. So what we saw is Coinbase issued a form 1099-K, which just showed the total amount that you either sold on Coinbase or withdrew, sent out of Coinbase. So if we had clients that were moving around crypto in circles from one account to the next, back around and around and around, and these 1099-K forms showed in some cases millions of dollars because it was their same activity just going around and around. So it's important to have all the records to be able to support all the activity, even though it may not all be reportable. Does that make sense?
Yeah, but it's one reason that the only way I bought Bitcoin in the last couple of years is GBTC, Greystone Bitcoin Trust. It's just a lot easier. Plus, you can do it in an IRA.
Yep. So
But it's ruining it because it really isn't of any value if it doesn't get used, as to do real transactions.
Well, not to go too far down that rabbit hole, but I think Bitcoin or crypto overall, there's a lot of different cryptos, right? And I guess specifically Bitcoin, most people argue its use is really as a store of value, not for daily transactions. And there's actual other levels of Bitcoin. For example, the Lightning Network, which is built on top of Bitcoin to help do things quicker. So, but overall, Bitcoin, most people see it as just a store of value rather than for daily use case. But I would agree overall, the taxes are a nightmare if it's going to be a world where people are going to be using crypto to buy a sandwich or a cup of coffee. So just to kind of go, I should stop. Any other questions?
Because I'm late, I didn't really know what your business was, but it seems to me like someone could write a wallet that did this taxing business, kept track of it on the side.
Yes. And so I don't know how far the slides are. There are other services out there. Bitcoin.tax, Zen Ledger, we work with both of them. They've both been in the industry for years that will help you through doing all the calculations, but it is tedious and it can be time consuming, especially if you have multiple exchanges or wallets. So hypothetically, it'd be great if Coinbase just did the work, issued you a report. Problem is, if you have withdrawals from other exchanges and other wallets, your own wallets, then Coinbase doesn't have all that data. So you'll have to use software like one of these to combine all the exchanges, all of your wallets, and create a overall tax report. So there is software out there that does it. And it's kind of like a do-it-yourself type solution. TurboTax for crypto taxes. So it's definitely something that could be done. Yeah.
Yeah, before you go too far away, because I've been trying but couldn't get to you. So back in a couple of slides before, when you started mentioning about legislation in areas and countries where legislations were better or worse, I was about to ask you if Liechtenstein, it's one of those places where the crypto regulation, it's a little better, more friendly, for lack of a better description, and it's not so heavy on taxation, but a little more, let's just go ahead and use it. You use a term that I don't want to say it, but it's like a tax haven, but it's a place where this kind of flow, financial flow, is a little more fluid rather than so bumpy and restrictive. Is that the case?
So the answer everyone hates to hear, yes and no. So as a US person, so if anyone is listening is a US person, and really everything I'm talking about is for US persons, US citizens, green card holders, H-1B, tax residents. If you're a US person, all of these rules apply. As a US person, you're taxed on a worldwide basis. which means it doesn't matter what country you're in and doing the activity. Doesn't matter what country the exchange is in. Doesn't matter where your business is located. If you're a U.S. person, you're taxed on a worldwide basis. So there are, I believe, Liechtenstein has more favorable tax laws, especially for crypto. They may even have zero tax. But if you're a U.S. person, you still are going to be subject to the U.S. tax laws. So the only way to avoid that would be you're not a U.S. person, you expatriate, give up your citizenship or green card status, then you could be subject to the tax laws of whatever country you're residing or a citizen of. Does that make sense?
Yes, it does completely. And one more question that I had, it was about remittances and family transfers and things like that. I think you already touched base a little when Marty asked you, but in the side of remittances, is there any specifics about that you have dealt with?
Yeah. So self-transfers, not reportable. Really nothing to do there. If you're transferring between your own wallets, your own exchange accounts. If you're giving or receiving a gift, then there are thresholds and things you need to be aware of. So if you're, doesn't matter who you're giving the gift to, if it's over $15,000, you as a person giving the gift needs to file a gift tax return. The recipient actually doesn't pay a tax, but the person giving the gift has to file a gift tax return. Once those gifts exceed, it's around $11 million during your lifetime, then you start having to pay a tax. The recipient of crypto gifts takes on the cost basis of the person that gave the gift. Say it again. The recipient of a crypto gift takes on the cost basis of the person that gave the gift. So you're giving a gift to a family member, to your children of crypto, something that's getting more and more common, putting crypto in a wallet for a child. You should write a gift letter that explains, and we can help people with this, that it is a gift, but also identifies your cost basis and your holding period, because that transfers over to the recipient. And that's, without that, there would be no way for them to know what it was. So then you have to calculate even what that cost basis or holding period is. And if you were exchanging crypto, that may not be so simple, but that's a suggestion. If it's a gift from a non-US person, so if you have family that's living abroad, non-US persons, they give you over $100,000 in value, you have to file a disclosure in the US. So if it's a gift from a non-US person over 100K that you receive, then you have to disclose it. But typically no tax on giving or receiving gifts, but there are these different disclosure type requirements. Any questions on that?
Yeah, so within the limit of those disclosures, let's say just regular remittance to family in and out of the United States, most likely out of the United States, the US citizen that is sending the money is not subject to taxation for those funds, right? Only for the part of those funds that were increase or gains during the lifetime of the fund in an exchange or whatever. Am I right?
Well, let's say you acquired Bitcoin at 10,000. Today it's 50,000. You gift a fraction of it, only $5,000 worth to a family member. Because the fair market value of 5,000 is less than 15,000, there's nothing to report. And then they would take your, well, if their country has similar reporting, they would take your cost basis of 10,000 per coin. So whatever that fraction is, 1,000 again, in our hypo. So you wouldn't pay a tax. And then when they sold it later, say it was a US person or subject to similar laws, when they sold it, then they would pay a tax on the difference between the sales price and their cost basis, which was your cost basis.
Gotcha. All right. I was thinking on the lines of TransferWise or any of this Western Union or things like that. People send money abroad, and not those big quantities, but just smaller quantities, $500 worth of coins or $1,000 max or whatever, and then the rest is just subject to the legal laws and whatever the money is going to. But that kind of transaction like you do, but that's okay. Thanks. You answered the question.
Andrew, I have two more questions. Japan, didn't they declare Bitcoin was legal tender there? Does that
Maybe.
affect
I'm
anything?
not sure. I'm not sure, to be honest.
And also, I think Cyprus. Well, okay. And the other thing is, when you inherit, seems to me when you inherit gold, if you're the heir, I think that the basis becomes what it was worth that day, right? Unlike what you're saying happens with Bitcoin, where you inherit the giver's basis. Is
Yes,
that true?
yes to all the above, because there's a difference between an inheritance and a
Okay.
gift, and that's the distinction. So if you inherit Bitcoin, you will get a step up in basis. If
Okay.
you receive it from someone who's living, you get their cost basis. So good, I guess, tax strategy is inherit rather than gift, but
Gotta
yeah,
wait.
the same rules apply though that with stocks as crypto for gifts. So yeah.
Okay.
Hi, Andrew. Two questions regarding Coinbase in particular. If you are moving money between Coinbase and Coinbase Pro, is that considered kind of moving between wallets, or is that just like one place?
Just a self-transfer, taxable. You may have some fees, but in general, not taxable.
Okay. And you said that like, so Coinbase might report that on that form that they generate for us. Does that mean that we shouldn't upload those forms directly to say like TurboTax, instead manually write out exactly what the transfers are, or the?
Yeah, so Coinbase used to be sending out 1099Ks after getting a lot of issues. So 1099K would show that total number.
Right.
And after a lot of complaints, they said, all right, we're done. We're not doing this anymore. Effective for, I believe, either 2020 or 2021, we're only going to send out 1099 miscellaneous. 1099 miscellaneous will show any rewards, or Coinbase has like an program.
Mhm.
If you have any income, they'll report that, but they're not going to show the total amount that went around anymore. Other exchanges still are. So overall, the 1099K form was never enough information to report. It was, and again, that's why the IRS, when they were getting those, were sending out these massive bills that were just overstated. There's never enough information. Coinbase never did the work for you. They do have a tax report that I believe is in beta, but if you have any other exchanges and you move crypto between wallets or exchanges, that tax report will fail because it doesn't have the data from the other places.
Right.
Overall, that's why either using a service, hiring us, or Bitcoin.tax, and Ledger to combine it all is what you have to do. In the stock world, you'll get a 1099B from financial institutions, E-Trade, Robinhood. Send you a 1099B, you give it to your accountant, it's easy. So far, don't really exist for crypto, and part of that is because exchanges aren't sharing data on cost basis. If you had an E-Trade account and a Morgan Stanley account, and you transferred stock from one to the other, nowadays they're generally sharing that cost basis information so you can have that on your 1099B. It's not happening in crypto. There's just not that level yet. I hope it happens, but then that kind of fights against the entire notion of crypto because we've got exchanges sharing information about you now. So, yeah.
Got it. And then one last question about Robinhood. When you buy crypto on Robinhood, you're not actually buying that actual crypto. So is that still treated like crypto when they report, or is that like a stock kind of purchase?
Same idea. Well, so I would agree with you. Right. If you're buying crypto on Robinhood, from what I understand, you don't actually own the crypto itself, but it's reported much the same way. And that's also true because the rules on stocks are really the same rules that apply to crypto too. Any other questions? I don't think we have that much more time, so I'd rather answer questions than keep going if you guys have more questions.
Well, Andrew, I have one question.
Yeah.
You were talking about trying to get a de minimis law passed.
Yeah.
Seems to me what you really want is just to get crypto declared as a
Currency.
well, a currency. Yeah, that would help. But I mean, I forgot the word already. I just mentioned it in Japan. They declared Bitcoin
Legal
to be
tender?
a what
Legal
was the
tender?
word? Yes, legal tender. Sorry, I'm 71.
It's okay.
Things come and go. So that was more of a comment than a statement. I would rather have it be declared a legal
Yeah.
legal tender, but seems unlikely. I actually did, but didn't Wyoming and Texas, they've declared gold as legal tender. I don't know what that means federally, but and I think Wyoming did the same thing for Bitcoin, but I don't know what it means.
Yeah. So
You don't have any knowledge of that?
past bills and laws trying to be more crypto favorable. Wyoming is one of the more famous ones, but you still have federal laws that
Yeah.
really
Okay.
trump, no pun intended, everything. And the federal tax, unless you're in Puerto Rico, is going to apply to you. So even if Wyoming, Nevada, Texas don't tax crypto or say, hey, we're not going to treat it like capital gains, the federal government, unfortunately, is still there.
Okay.
So moving on, is there anything else that you think that we should cover that is important for us to know in this realm?
So, I mean, this is just kind of detailed on how to report it, but I think that that's probably too specific. Talked about software. At the end of the calculation, so on 8949, the form on the left is where you actually report all of your activity. And generally, we'll even just provide an attachment to the tax returns rather than using the forms because they can be pages and pages depending on the client. But all the gains and losses then are netted. And they're also netted against stock gains or losses. So if you have gains, losses, break even, it's important to report it all. And also losses can be used in future years. So we've had a lot of clients that have said, I don't need to report the old stuff. I've got a loss. If the IRS audits me, I'll show a loss. First of all, it's going to cost you a lot of money to defend that you had a loss, but also it's to your benefit to report it because you can carry it forward to future years. So a lot of people had losses, for instance, in 2018, crypto price went down. People were trading throughout. Now prices are sky high. And hopefully if you reported in those earlier years, you have those losses. If you didn't report, we can report now, take those losses and put you in a better position now. So losses still should be reported. Everything should be.
And there was a question in the chat about crypto futures. Is that just kind of reported in the same way then?
Yes. Yeah, I don't recall offhand exactly how futures are reported, but yeah, it would follow much of the same form as just any other futures would be.
Hi, Andrew. This is Vishal. A quick question in terms of sort of avoiding some of the tax headaches, stuff like grayscale ETFs. So if you don't get into crypto but want to get exposure, what are the most reporting friendly options? Is it the ETFs, or are there some restrictions on how these ETFs can be traded within IRAs, or any advice on that?
Yeah, so probably the easiest one is the grayscale GBTC, because it's pretty much just like a stock. And they're reporting, if you hold it through Robinhood or E-Trade, they'll do much of the reporting for you, and it's very straightforward. If I was in other groups and said that, they would kick me out. They'd say GBTC is not BTC. You're just investing in it, but you're not really holding the Bitcoin. So different people have different views on it. There's the statement, not your keys, not your crypto. And so, if you really just want investment exposure, something like that could provide it. From what I understand, they do have fees that they charge and so forth to administer it. So it's not like you're getting dollar for dollar gains as the price of Bitcoin goes up, but it is, from a reporting standpoint, much simpler. It's just different.
There's also, if you have Bitcoin in an IRA, in particular a Roth IRA, you don't have to report anything, right? I can do all the transactions I want. If it's all out of my Roth IRA, it's easy.
Yeah, so there are a lot of people that have set up or hold crypto in an IRA, and depending on the type of IRA, there can be tax deferral on all those gains. And so, yeah, generally you have to set up like a self-directed IRA, and there are companies out there that can help you do that too. So definitely an option that's out there, and that can be done either by holding something like GBTC or the underlying Bitcoin itself.
Yeah, well, if you had the Bitcoin itself, you could actually go to a coffee shop with your wallet, and well, it's a little more complicated than that. Never mind.
So I see that the next slide is on mining. I know that this is a big topic right now because we have more networks that are doing this. So this is, yeah, I want to hear more.
Sure. Yeah. So mining, staking, rewards, all in general, forks, airdrops, income at the fair market value at the time it's received, and it's generally taxed at your ordinary tax rate. So it's a lot like interest on a bank account, except interest in a bank account is in USD. A reward is generally denominated in the crypto, but it's still taxed to you at that fair market value. So even if the price goes up or down, whatever that price was when you received it, that's what you're going to be taxed on.
So this isn't as big of an issue now because I think that the days of just massive Ethereum airdrops are kind of over. But what about all those airdrops where they just shove something in everybody's wallet and you don't even look at it? How much do you have to worry about those, and or what kind of leeway do you have to say like, hey, I never looked at that, I never touched it, I've even moved on from that wallet, so therefore I don't have to think about it or report it?
Yeah, so the IRS didn't discuss, when they issued the guidance on airdrops and forks, they didn't talk about, well, what about the shit coins and the marketing airdrops that you don't really want? What they really just referred to as, well, if you have something that appeared and you have an ascension of wealth, then you have to report it. What we would suggest as a general best practice is pick it up for a cent, a dollar, whatever that value is, even if it's very minimal. But there's also a position that you didn't actually take it, you just abandon it, which, and that's where it's kind of gray with some of these shit coins is, if you really didn't want it, and some of them are just really out there that you could appear on your Ethereum or other crypto wallets, it's hard to say. On the other hand, one of our first clients is one of the co-founders of Ethereum. A airdrop to him of even some garbage token can be tens of thousands of dollars. So it kind of depends. Also, some of these tokens may sound like garbage now and then increase in value over the years, and then you want them. Well, if you didn't report it initially, then you don't have cost basis, you don't have a holding period. So later when you sell it, you'd have less favorable tax events. So it's kind of a tough question to answer. When it comes down to like the real garbage ones, I think you're generally safe not reporting it, but the IRS guidance itself doesn't discuss that. It just says report whenever you have a new ascension of wealth.
Okay. And in terms of staking rewards, that's something that I was wondering about. In terms of, I understand that if you have staking rewards, it's going to become income and you're going to have to pay the tax on that. Are there ways to help to mitigate that if you wanted to give it away as gifts or donate it to charity or something, so that maybe you just want to hold, maybe you just want to hodl and you don't want to worry about the staking, but you have these rewards coming in. What kind of strategies can be planned for there?
Yeah, so staking rewards, especially with, for instance, looking like Ethereum, $2,000 today. If you're receiving rewards and then it's taxed to you at today's fair market value, then say it goes down in a month and it's 1,000. Too bad, you still have income at that price of 2,000. Still have to pay tax on the rewards at that fair market value. So a strategy that we often suggest to clients is have a process or policy for selling a portion of your rewards for fiat or stable tokens as they're incurred. So you're at least covering your tax despite fluctuations in price. So that way, even if it drops to 1,000, you at least have your tax covered. So if you're long-term and just want to hold, that's what we would suggest. Of course, you have to make your own tax and investment decisions, but at least that way you're covered. But yeah, it's kind of a concern generally with how staking rewards are taxed. Donations, so taking a step back, gifts are not a tax deduction. They're not taxable to you or the recipient, but they're not a deduction. Donations are a great tax strategy. The key here is to donate appreciated crypto. So don't sell the crypto for cash and then donate the cash, then you'll have a gain. Donate appreciated crypto, you'll get a deduction for the fair market value of the crypto without having to sell it first. You have to find a charity that, number one, is a 501c3 or registered charity, but also that accepts crypto. But if you can do that, it is a great tax strategy.
That's great. Thanks.
Yeah, sure. Any other questions? So I guess just in closing, tax season is here. We're a couple months away from the tax deadline. Now is really the time to get started. If you had any trades in 2020 crypto, any trades at all during the year, to get it all reconciled and reported on your tax return. We started the conversation talking about the question on your tax return for the 2020 year about crypto. So it is going to be front and center. You're going to have to address it. And if it's your first time reporting, that's okay too. But you generally can't just start with 2020 because you need your cost basis from the earlier years. So in most situations, we would suggest going back, getting it all reconciled, then moving forward. Hold for longer than a year, donate crypto. We talked about that. Report losses, not just gains, but report everything. Tax loss harvesting is when you sell crypto that you're holding at a loss so that you could have that loss for future gains, to offset future gains. So that's a good strategy. And if you are trading for a living, you don't have another occupation, it's what you're doing, you're trading multiple times during a day, you may be eligible for trader tax status, which will allow you to take deductions for things like computers, home office, and stuff like that. But if you want to talk about that, reach out to us. It's very fact intensive and it depends really on your activity. The best suggestion I have seems very simple, but keep track of your transactions and your holdings. Download records from exchanges, from your wallets. Exchanges come and go, but having all your records will only help you in the end. So keep track of everything. That is the end. We have a lot of free information on our social media, on our website. We have an FAQ if you have any questions also that have a lot of answers. So check us out. Any other questions though?
The last question I saw is if you could point to any resources about Roth, IRA Roth cryptos and self-directed IRAs like you kind of mentioned earlier.
I'm not sure if we have anything on our site. We may. Check our site, search for crypto IRA. We have literally more articles than I can count on crypto topics. So we may. Otherwise, yeah. Unfortunately, I'd say just Google or reach out to us.
All right. Well, thank you so much for the presentation. I'll go ahead and stop the recording.